All right, so we'll go ahead and get started. First, I just wanted to thank everyone for joining us today. This is James Medifine. I'm the founder of Medifine Retail with Marcus and Millichap. And we're excited to organize this call today because we wanted to just discuss the topic that we've been hearing from a lot of our clients, which is, I know, on everyone's mind, and that's the COVID-19 pandemic that a lot of the retailers that we're working with and our friends are all, being pretty severely impacted by. And so we've been proactively speaking with hundreds of our owners in different markets throughout the Southeast, and would like to share with you just some of our best practices that we've learned through those conversations, and also trying to understand how others have been effective in managing their portfolio, whether it be a shopping center or a net lease property, despite many of the closures and the uncertainty that exists with most retail tenants. And so what we'll do is we'll start with a review of the state of the market, and that's really to understand what has happened and where the retail market is today. And specifically, we wanted to discuss how the real estate values have been impacted, and then also discuss what we're hearing related to the tenants' ability to survive in today's market, because I know the success of our tenants is on a lot of our minds, mainly because we want to continue receiving our rent payments. After that, we'll plan on discussing what properties are best positioned for success in today's environment. A lot of landlords are looking at their tenant mix today, trying to say, okay, how do I stand, or how does my outlook look today, and then what can I do better in the future to try and make a stronger property, a stronger investment for myself. And again, we'll separate this by both multi-tenant and then also single tenant property types. And then after this, we'll discuss some ideas and strategies that owners have been implementing to navigate the uncertainty, and then also how some owners have even been working to benefit from the situation. So while there may be a period of lower cash flow, we believe there are ways to put yourself in a better position long term. Now, one of the most common questions that we've been fielding today is understanding how banks and lenders are reacting to the market shift. Are they still lending, and what are they going to do to help clients who are experiencing cash flow shortages? Many of you may have properties under contract right now, and you've been in daily communication with your mortgage broker or the lender that you're working with directly. And some lenders are moving forward with deals, but as you know, some lenders are not. They're pulling back and more or less in a holding pattern, trying to decide how they should best respond or what their new strategy is in terms of offering additional debt. And so after that, we'll share with you some more information about what we've been experiencing on deals that we're currently working on. We have 7 shopping centers currently under contract, and each day I've been navigating how to still complete those transactions, and then also advising clients with our active listings on how they can ensure they don't leave any money on the table if they are deciding to sell now or in the short term. I do want to remind everyone that there is space at the bottom of your screen to ask questions throughout the call, and we'll plan on answering any and all questions at the very end. If you have any additional questions or would like to discuss your specific situation in more detail, we're always available as a resource. Please call us at any time, even if you're not looking to sell your real estate, because we'll always do whatever is needed to help ensure that you are successful. So for those of you who have not worked with us yet, Medifine Retail is a group of investment sales professionals, and we exclusively sell shopping centers and net lease properties throughout the Southeast United States. We've sold more than 170 investment properties over the past 9 years, and we have a total value of almost those sales totaled almost $500 million.
Hey, Medifine, this is James Garner. Just going to pick up here and kind of explain how our team is segmented and how we add value to clients. So there's really 2 segments of our team. There's multi-tenant retail, shopping centers, and then there's also single-tenant net lease. James Medifine and Jim Schiebler head the multi-tenant side, along with Evan Kanan and Michael Mohammed. They each have their own specific focuses and geographic focuses to make sure we're covering all Florida markets. And then Jim and myself head the single-tenant net lease side, and we've really built a business on specialization. Although our team has a track record across all single-tenant net lease sectors, we find that we add a lot of value when we can provide specialized expertise on, say, the restaurant sector, the bank sector, et cetera. So myself and Jim have an extensive track record with restaurants, but Aaron Bergland is helping us head that specialization and take it to a further level. So he also specializes on the restaurant side. And then Reed specializes on the bank side. And obviously, with the changing bank environment, there's a lot of moving parts, and it helps to really have a specialist if you're looking to buy or sell a bank-related property. So our platform as a whole, with Marcus Millichap, our team, and our processes is extremely powerful, helping people not only maximize the value throughout their hold period, but also maximizing net proceeds in a sale. And Jim, if you don't mind briefly covering that, Metafine, if you can move to the next slide, we'll just cover that briefly before we go into the meat and potatoes of this webcast.
Good afternoon, everyone. Jim Sheeler speaking. Thank you again for tuning in. A little bit about Marcus Millichap and Metafine Retail. Our Marcus Millichap, we have 50 years of specialization and experience through multiple cycles. We pride ourselves on providing dedication and support to our clients in real time. And really strengthening client relationships is what we do best during market disruptions. We know long term we will all come through this stronger and better, like every past cycle. Our team and our company is made up of specialists, and we specialize really 3 times over. First is market specialists, a specific area geographically. Second is we only do investment real estate sales. And third is we are a true product type specialist, not only in the product type, but also in the specific tranche or sector, as James mentioned, banks or restaurants or shopping centers. We currently have 2,000 brokers in 80 offices, and really collaboration is one of our main value propositions. Specifically about Metafine Retail, last year we closed $136 million in volume. We average between 95 and 96% list to close ratio on our dispositions for our sellers. We work with clients in 37 different states and growing each and every month. And our theory and value proposition is that real estate is sold and not purchased. And we pride ourselves on operating with integrity and transparency. We strive to build long-term relationships with our clients, and our mantra is really we build clients for life. And we work with most clients outside of a transaction, as transactional velocity is only 4% annually. And then when our clients are ready to transact, we are most prepared to deliver the highest price for them on their behalf. And then, we really have 3 goals when we're executing a sale for our clients. It's deliver the highest strike price within the shortest time frame with the easiest process. And now James Metafine is going to talk about the state of the market.
Yeah, so as everyone has personally experienced, the federal government has taken some extreme measures to try and flatten the curve with coronavirus. It's all over the news, right? Schools are shut down, restaurants and gyms are mandated to close, with the exception of takeout and delivery, which is a small portion of their business overall. And as of this week, all non-essential businesses have been closed, and people are strongly urged to stay home at all costs. And this impact will not only be on those tenants, but also a lot of the supporting tenants who are tenants in our shopping centers and are a big part of the livelihood and income and investment that we've made in our lives. And so I think coming up with a plan on how they can succeed is really important. Now, because of the rapid and extensive cuts that were made, the government, the tenants, and property owners have had a hard time determining how long and how severe this impact will be to the economy. And so from the reports that we've read, most economists have stated that anyone who tells you a specific is purely guessing at this point in time. No one will know until we see the statistics as it relates to the coronavirus infections. And so we're recommending planning for the long term with hoping for the short term in terms of the impact it'll have here in our economy. And things that they'll be looking for, the statistics they'll be looking for to get things back on track will be, they'll want to see a reduction in the number of new cases and then also see a drop in the death rate. So once this occurs, we anticipate seeing businesses start to open back up again. A big piece of this is also going to be the necessity of additional testing. Right now, we're not able to test nearly enough people, so the extensiveness of the infections are really a big unknown. All of those items together are what's causing some of the panic, but also the uncertainty and the cautiousness of investors who are buying real estate, investors who currently own real estate, and then just everyone who's trying to make the best decisions they can for their family. Now, most tenants, investors, and lenders have pulled back for the time being. I think once they have their arms around the extent of the economic impact, we do expect real estate investors and lenders to be a little bit more comfortable in terms of committing to new deals. So it appears that multi-tenant retail has been impacted much more dramatically than any other product type, and that's because the tenants have been impacted a lot more than any of the other major product types. The only exception probably being hospitality. With travel restrictions in place and people canceling vacations, they've seen a huge drop in reservations, which is expected as well. Now, single-tenant properties, they'll be impacted by varying degrees. So far, restaurants and some of the other banks, some of the other tenants that are still operating and still open for business to some extent, seem to be having very reasonable sales numbers. Tenants that are being forced to close, those are the ones that we see being impacted the most. Now, we do see the Fed has been doing everything possible to encourage additional investment and relief for different lenders and consumers. Some of that comes from the Fed dropping rates close to zero, and they're aggressively deploying cash into the economy. Now, the extent of the impact on the retailer's bottom line has been softened by this, but I really think more will need to be done by legislators and then also the population in order to ensure that the recovery is swift. Most economists are looking for that V-shaped curve, right? When it comes to recovery, we went down fast. They expect us to try and recover fast. But without knowing how long businesses are going to be out of business, it's really tough to say for sure whether or not that'll be the case. The good news is the legislator did take action on the relief package yesterday, but how we recover will really be dependent upon the actions they take in the coming weeks or months. So in summary, this all just means that tenants are going to be struggling for an undetermined amount of time. I wish I had better news. Some of the tenants will not be able to recover most likely, and the impact and will be impacting or forcing others really to change their business plan and adapt, which I think will be good long term. Now, this will make them stronger, we think, and then the diverse offering, including delivery, operating remotely, and then providing a more convenient service for customers, will benefit both the consumer and the retailer long term. And then forcing them to also have a larger presence online, we think will be good. So it'll help bump people in the right direction towards longer term sustainability if they can make it through this downturn in the cycle in the market. We do know landlords have been impacted in short term, and they likely will be. So cash is king. As long as landlords have cash reserves, we would expect them to fare fairly well in all else considering. It's landlords that are highly leveraged, just like in the last downturn, or landlords that don't have the capital reserves that we think will be forced to sell or be forced to look at their alternatives, whether bringing in additional capital or even worst case, giving their properties back to the bank. We don't anticipate this to be a large percentage of the shopping centers or single tenant owners nationwide, but there may be a few opportunities for opportunistic investors to find something of value from these types of owners that didn't plan for situations like this.
Yeah, so things have drastically changed from where they were even just a couple weeks ago, and so I think both tenants and landlords are going to need to learn how to adapt and adjust to some things. But this isn't the first time that tenants and landlords have had to adjust to market surprises. I think that last time during the recession, it was some of the most difficult times many of us have ever seen. I think we've had quite a long run recently in terms of the market being good. And so we all expected a correction. I don't think any of us could have anticipated, though, how it all kind of played out. So what I plan to do with these graphs is just show you a brief overview of the situation. I know a lot of you are probably stuck in quarantine. You're probably reading this every day. And so I'm not going to go into much detail, but explain the context of it so that we can further discuss how it impacts commercial real estate and investments. So you can see in the first graph on the left, we started hearing about initial reports of the coronavirus back in January. and that was over in mainland China, but it really didn't start to move outside of China until late February, early March. And then really it didn't impact many US lives until just in the past week or so. And you'll see here, the corona cases outside of China spiked dramatically. As Medifine referenced, having that V versus a U, the hope is that we can recover in the same pattern. The graph on the right shows US coronavirus cases by density in terms of the reported cases. You'll notice that the more dense states in terms of reported cases are some of the most populous states in the US, like New York, California. Florida is definitely one that now is taking some action to try and flatten that curve because it is a very populous state, and with a lot of migration from the Southeast and from visitors from the West, it's a potential for that to spike as well. And so, Medifine, if you could go to the next slide. I think this just explains why we're doing what we're doing, because obviously this has been a big hit to the economy. It's hurt a lot of businesses just being shut down for a couple of days. And so really, the faster we can get people back out there spending and businesses back open, the faster our economy can bounce back. But we also have to be conscious to the public safety and health of the spread of this virus. And so the question is, why are we shutting down? Why is everyone being encouraged to stay home? And the reason is expressed by this graph here. So flattening that curve, without doing that, the virus can spread far more rapidly. And if it exceeds the healthcare capacity, then not only is it going to be a detriment to the economy, but it's going to be a detriment to public health and safety. And, so the hope is that the healthcare system, by having everyone stay at home, can live within that capacity to be able to support and get people better that are impacted by this virus. At the same time, we're hoping that will happen quickly so that we can bounce back and get businesses back open again. Now, Medifine, I think you were going to speak on some past corrections, and obviously past performance is not an indication of future performance, but I really like this data because it shows an optimistic view of what we might expect over the next coming months as we do begin to recover from this. So Medifine, why don't you take it away? Might be on mute.
Thank you very much. This is I appreciate that. This is a table that we like a lot because it shows the 5 economic, the indicators of the 5 economic disasters and the average impact that each has had in the history of the U.S. economy. And so those 5 largest events, they've been the 1973 OPEC oil crisis, the Iranian revolutionary and energy crisis, the Iraq and Kuwait war, the dot-com bust, which also incorporated 9/11, and then most recently the Great Recession. And so during these events, the S&P 500 has dropped 35.1%, which is what you'll see on the left-hand side of the screen. The GDP dropped 2.1% on average. The employment rate dropped 3.1%, and the unemployment rate dropped 370 basis points, and then retail sales went down by 4.5%. And so in recent weeks, more than 8% of the country's population has filed for unemployment, which is huge. So it's a much bigger impact than we've seen in these on average than we've seen historically. And then the S&P 500 has gone up and down like a seesaw, but overall has dropped more than 30%. And so while the impact recently has been more severe than the average historic events, the recovery has oftentimes mimicked or exceeded the drop in the 12 months of recovery. So once we start to see an increase in the recovery cycle is when we start to see what's in this green box here, and that's the run up from the bottom basically. And so once we start to see a recovery, and again, we don't know exactly when that'll be, but we would anticipate an even or greater economic growth cycle. So if the S&P went down by 30% this time, it's probably going to go up by another 30% or more, as that's what's happened in the past. The same goes for GDP growth, employment growth, unemployment rate, and also retail sales. I just wanted to point out the other green boxes here. These are all items that show what the specifics are related to each event. I think for us, we're not really similar to any of these, but I think that's why if we look at the average, we'll have a good indicator in terms of what it'll look like as we start to come out of this downturn. And so there are some actions that the Fed has already taken. We all know that they cut rates almost to zero, and this is all to encourage lending and investment, given the uncertainty that exists in the economy. They are also deploying massive amounts of cash, and that's expected to hold the economy for the short term, but it's really not a good long-term solution. And so it's not going to benefit us in the COVID-19 kind of epidemic that we're in right now, or pandemic. It's unknown what the Fed will do next. I think the legislature will be be a big driving force in terms of recovery efforts. I know they passed a bill yesterday to also hold us over in the short term, but what policies and what assistance they can provide in the long term as we start to come out of this recovery, to start to leave the bottom and start to see things get back to normal. And so all of these impact our properties that we own. And so I think Jim wants to tell us a little bit about what he thinks will happen towards specific assets, which I think will be very valuable.
Terrific. Thank you, James. Jim Schiebler here. So, what does this mean for your retail investment property? Well, obviously, each situation is different. It's really a case by case, and it can be different based on your tenant lineup. If you own a shopping center, and very, very different next door neighbors can have different levels of vulnerability, susceptibility, and game plans. Our advice for multi-tenant is to really evaluate your situation. And we know that one area of focus is the lease escape clause for tenants. And so we recommend that our landlords consult their counsel regarding these clauses to assess tenants' ability to extract themselves out of certain lease obligations. And these clauses would include this force majeure, the act of God, and also the damage and destruction clause. So we think each one of those is a case-by-case basis. Really also evaluate your tenant lineup and situation and assess the value of the tenant. I mean, this might sound a little strong, but while you're in this situation, there are opportunities to also create for certain landlords in certain situations. For example, if a shopping center wants to go through an upgrade and they have a tenant that has been very weak and also is kind of holding the center back, well, maybe this is an opportunity to make a clean break. Now, obviously, we emphasize to use empathy and sympathy and to have compassion. But really, every tenant is going to have a different rating and a different level of pedigree. And really, multi-tenant retail, what synergy do they also bring to their property? And maybe can you upgrade in this type of environment? We know it is a fluid environment with many consistent dynamics. And a lot of the tenants and franchisees, they will look to the landlord as the first line of relief. But really what we find is the first line of relief is really in a net lease deal, your franchisor for that franchisee. Second would be your business insurance company policy. Third would be your small business loan, especially now because they're providing certain forgiveness of that lending based on your retention of your employees. And so obviously there's connectivity there. And then landlord really is your tenant's final line of defense. And so you really want to assess independently your tenant's vulnerability. Now, obviously, essential service-based tenants are most fortified. Those include grocers, drugstores, discount stores like dollar stores, gas station C-stores, medical and healthcare properties, including office properties, urgent care, and any type of medical tenant. Your secondary tenant is going to be your quick service restaurants. These would be fast foods. Specifically because they have a drive-through, and now with the visit-in or dine-in casual restaurants being virtually closed and out of business at this moment, we find the funneling on a massive scale through the drive-throughs. So a lot of the drive-throughs are actually the QSRs with drive-throughs are actually up in sales. So that's definitely a product type that has a high level of resiliency in this climate. And then obviously your most vulnerable product types are your traditional sit-down restaurants, that have, that really didn't get ahead of the curve and use forward thinking up until this point, where they have limited takeout and delivery options. They obviously are suffering. Banks as well, and some markets have shut down banks completely. And I want to elaborate on banks specifically, as there is an older clientele that is very used to going to the bank. They have not adopted the e-commerce model and the online banking through your phone or through your tablet or online on your computer. And this situation, this chapter is forcing those clients that were in-branch visitors to now learn to be online and to learn online banking. And it's really forced them to get over the stigma, the fear, the intimidation. And they're going to learn a few things. One, it's easy. Two, they're over that fear factor. And three, it's efficient. And so we're anticipating banks really having a long-lasting effect based on that dynamic and how it's unfolded organically. Additional product type tenants that are vulnerable: auto parts and department stores, fitness centers, movie theaters, which are often anchors of shopping centers, office buildings, and service-based close contact tenants. Those would include salons, barbers, any type of beauty tenant, and massage and spas, and many more. And there's also another side of the coin. If you try to potentially upgrade your tenant in this situation and cut a weak component of your center, leasing has also hit the brakes. There's really nothing happening on that front. So you need to be realistic on your ability to backfill a unit and what type of demand, both from a tenant and a return perspective. So tenant retention obviously is critical during this timeline. And we'd also recommend, and we hear this from a lot of landlords, and we're steering them as well strategically, is they do have leverage in this situation. So they can work strategically to get something in return. Obviously, you want to balance that with sensitivity and empathy and compassion, okay? And we want to make that clear. But for example, converting a double net lease to a triple net lease, or introducing a sales reporting provision into the lease so you can not only monitor how they're recovering, but in the future, understand how your tenants are performing. And then also solidify the lease guarantee on a lease. Often there's ambiguity. Tenants cannot be forthright as far as giving you that transparency, and obviously that's important. That is an opportunity. And then some landlords are also saying, okay, we'll give you some relief here, but in return we want you to extend your option period early. And then, you have to also, understand that tenants do talk, and you're going to have neighbors that are going to compare the concessions. So that's something to obviously have top of mind. And then another creative strategy is okay, if a landlord is going to give a 60 or 90-day rent abatement, well, there's a couple of strategies. Number one, they could tack it on the back end of the lease and add those months. Two, they could double the amount of months, and they'll give you 2 months concessions, but in return, I'm going to put 4 months on the back of your lease. And or you could arrange payments and amortize that absence of revenue over the base term of the lease. And, again, we want to emphasize, having empathy for your tenant situation, and often these type of opportunities create, lifelong tenants. And they will certainly remember you during your period of compassion, not just as their landlord into the future.
On the single tenant side, it's very similar. I mean, Jim touched on a number of the tenants that are poised to push through this, and then some of the tenants that are at risk. It's very similar on the single tenant side. He talked about grocers, drugstores, medical office, dollar stores that are often anchors, and on the multi-tenant side, a lot of those also have single tenant footprints. And so those are poised to do really well. And in fact, a number of those sectors have started hiring more and planning for expansion because they're trying to handle the additional volume that they've been seeing from the arbitrage people who cannot frequent some of these other establishments, or they're trying to prepare to be ready to stay at home. And so from a distribution standpoint, these concepts are looking to make sure they can keep up with the demand for everything. And then alternatively, you talk about the ones that are at most risk. As Jim mentioned on the casual dining side, while a lot of restaurants are also anchors for shopping centers, on the single tenant side, you're almost at more risk with the casual dining concept because you have a larger footprint than your QSR. So they have a much larger rent obligation that they need to cover. And now they're being forced to be shut down. Some of them are staying open for takeout and delivery, but like Jim mentioned, they've been lagging behind in terms of getting the processes up to be able to sustain that volume. And so the casual dining side, the banks, auto parts, fitness centers, anywhere where there's large congregations, and in order to run a volume of guests, you need people to be in the same area. Obviously, in the short term, those are going to be hit the hardest. And quick service restaurants kind of fall into both categories. Some quick service restaurants are poised to do very well. And like Jim mentioned, some of the sales have actually been increasing because while people can't go out to casual dining, they can still run through a drive-through. And so the quick service restaurants are fielding more volume than they might normally do in any other given situation. But some other QSRs and the operators behind them have, in the recent past, been expanding pretty rapidly. And so some of them may be over leveraged. They may be tight on cash, and they may already be requesting rent abatements from their landlords. In fact, we've had a number of our clients reach out that a number of sectors and tenants, from corporate guys to smaller franchisees, are already asking for rent abatements. And so that's something to be aware of in terms of assessing vulnerability, creditworthiness, really digging into who the tenant is. And some of the things you can do in terms of proactive action are revisiting your leases. So read through them. Some of the items and the potential solutions that Jim brought up, it's going to become clear in your leases. So review your leases, have a trusted broker review your leases, have trusted legal counsel review your leases, and try to just understand and get ahead of what your potential remedies are if you start to encounter some of this. Analyze your specific tenant and see if they're still open and operating. If you have one of these tenants that are poised to do well in this scenario or push through this, some of them are still closing certain stores and having like a main store hub. So maybe see if your specific location is still open and operating. Do everything you can to analyze the tenant, to be prepared to have those conversations with them if they approach you about some sort of concession. I think two of the most important points to cover on the single tenant side are, first, making sure you structure both a short-term and long-term business plan for each asset. You want to make sure you have a contingency for what you're going to do in the short term, and also understand how this can impact the long-term sustainability of that asset in your portfolio. And part of that is also analyzing your site for worst case scenario. If your tenant does leave, if your tenant cannot sustain that rent, what will you do? Running a void analysis, a development analysis, a rent market study to understand the viability of the rental stream and the sustainability of the asset long term is important. That way you have a game plan. If something does happen, you can go ahead and move forward on. And I think one of the most important points is to proactively communicate, specifically with your tenants. I mean, it might be initial gut reaction to kind of just sit back and hope for the best and hope you don't hear from them. But I think that proactive action and proactive communication is what you're going to do to avoid surprises and facilitate compromise. I mean, if you're speaking to your tenant, you can get ahead of any challenges that they're already running into. And having that open communication, as opposed to hoping everything stays quiet and then the next thing you know, you get a letter in the mail saying that they need to close their doors. So I think that it's more important to work and improve that tenant-landlord relationship by openly communicating and being able to compromise. Now, obviously, everyone's situation is different. Not everyone has the capacity to compromise by giving multiple months of rent abatement, especially when you have mortgage obligations and financial obligations of your own. But I think the end goal here is for everyone to come out of this alive in a win-win. And if tenants are beating down the landlord's doors for free rent with no compromise, and the landlords are saying, no, you need to pay me with no compromise, no one wins in that scenario, because the tenant's going to go out of business and the landlord's going to lose the cash flow stream. So I think it's definitely important to proactively communicate, and that's how you're going to create that win-win and how we're all going to get through this together. I think similarly, what to expect from lenders on new deals and how to work with existing lenders kind of carries some of the same things. Medify, if you can change the slide for me. Lenders are still doing deals. And I think it just depends on the specifics of those deals. We're still getting deals done. I think while the Fed reduction in rates, as Medify mentioned before, dropped it down to 0, it doesn't necessarily have a correlation with interest rates. I think most lenders are going to have a floor on what they can do on interest rates. And with that said, the environment we're currently in is still a great time to capture some really cheap debt. And while most lenders have put a pause on multi-tenant retail, there's still long-term secured net lease deals that they have an appetite for. And so the way that this situation is different from the last recession we had is that lenders haven't just shut down. They're being more critical in certain product types, but deals can still get done and loans are still closing. I think it just depends on the specifics of your deal. And back to the idea of proactive communication, whether it's on new deals, and instead of saying, well, lending is on pause, speak to your lender or your mortgage broker about what the options are, because you should still be able to get some deals done. And then additionally, speak to your current lender on your existing mortgage. I mean, proactive communication there is what's also going to facilitate compromise on their end. If you're working on a compromise with tenants and what they need to stay in business is a rent abatement, have that conversation with your lender and see what they're willing to work with you on in terms of an abatement on a mortgage or some sort of restructure of your current financing to make sure that everyone wins and everyone comes out of this. Medify, you might be on mute.
Second time, thank you. What this tells us is that there's no better time in the last 5 to 6 years to finance properties. And so what this chart shows us is the last 30 years of financing, with the blue line being the average cap rate, with the orange line being the 10-year treasury. Historically, that rate has capped out around 430 to 450 basis points. It got down to as narrow as 200 basis points in 2006, which really wasn't that attractive time to buy, at least if you were planning to leverage. And so if you fast forward to today, we currently have about 510 basis points between the current average cap rate for investment properties and the 10-year treasury rate. And so if you are planning on using debt, or if you have existing financing or equity built up in your property and you're planning on refinancing, now's a good time to take advantage of that. There's a lot of different options out there. If you're looking for non-recourse financing, your options are a little bit more limited because of some of the most recent turmoil we've seen in the market. CMBS and life companies have pulled back a little bit, but banks are fairly confident and still lending money, as James Garner mentioned. And so certainly take a look at this in terms of how it relates to your portfolio and what your long-term plans are. But it is a great opportunity to improve your return, to tap into existing equity, and hopefully buy some of those opportunities that might be coming to market as a result of the turmoil that we've seen most recently. So some of the key takeaways that I have in terms of working with existing lenders or financing is there's still a lot of fluidity in the marketplace. There's still a lot of lenders that are financing deals. But if you have a shopping center with short-term leases, or you have a net lease deal on a short-term, that risk will be judged a lot harsher than it probably would have been just 6 months ago, when the economy was continuing to improve and people thought there was no end in sight in terms of our growth, and some of the impacts that we're seeing from expanding brands, that type of thing. So borrower strength from the lenders we've talked to most recently is more important than ever. This was about 10 years ago is when they started refocusing on this, and they've continued to be pretty stringent during this most recent recovery cycle. We expect those to tighten down even more. And so if you do plan on borrowing money, it's really important that you take a look at your cash flow, how much liquidity you have, and then also be able to demonstrate to the lender that you're a safe bet, and they should be able to, and if you are, they should be able to offer you very, very attractive terms. A lot of lenders, most of them anyways, that are active today are requiring personal guarantees. A lot of investors prefer to try and find a non-recourse route, but those are becoming harder and harder to find with some of the uncertainty that we're seeing. And it was even hard to find a few months ago, simply because the CMBS lenders weren't as attractive in terms of rates as like banks, for example. Some creative solutions. There are some creative solutions that we've been able to do for some of our existing clients. And the key is to keeping your options as open as possible. And so if a lender is concerned about your rent roll, we've been successful in having a reserve allowance for a short period of time that is released once the leases are renewed. So those deals that maybe weren't financeable initially are now financeable, just by offering a little bit extra liquidity for a shorter period of time. On a couple of our existing deals, we are negotiating some rent guarantees from sellers. And so that's really important to help buyers feel comfortable if you do have a deal that you're working on right now, because most buyers are assuming that there's going to be some delinquency from the existing tenant mix, being that they're closed for business, open limited hours, or restricted in terms of their offerings or what they can do. And so any existing properties that you have under contract or analyzing, and consider some of those specific terms. If you do have a property under contract and you're trying to figure out how to still make it happen, feel free to give us a call. Even if we're not involved in the sale, we're happy to share some of our experiences and what we've done with other clients to still get properties to the finish line. The most important kind of part in my eyes is what we call the red zone. And so the red zone relates to what I was just talking about, and that's how do we push deals forward in today's environment, because it is pretty tricky, especially if you have a deal currently under contract or currently listed, to still maintain the same purchase price or continue to move it forward under the same terms that we all thought we were going to enter into when we committed to it a month or two ago.
Great, thanks, James. This is Jim Schiebler, and if we are marketing a property right now or plan to bring a property to market, we definitely think timing is of the essence. It's important for every investor and landlord to assess their situation, as each day could mean significant equity lost. We heard a phrase earlier, it's just not changing by the day, but it's changing by the hour. And, in some cases, a pause may be the ideal strategy. For example, sit-down restaurants, movie theaters, fitness centers, and they're at the very bottom right now. We do believe that this is the catalyst for a recession, and within the next 2 to 4 years, if an owner wants to sell, we believe that the values will decrease, cap rates will increase, and we recommend selling sooner rather than later. There's a few reasons. There's actually some advantages. Number one, competition is limited. On the market, some sellers have paused, and so the competition that your property is competing with is very limited. And then before the bleeding and steals flood the market with distressed assets or bank-owned deals, which will be ultimately your competition at that time, there is a window to transact. And what's interesting is an owner might take a slight loss in this unusual climate, but when they exit their down leg, if they're 1031 exchanging or just purchasing, when they redeploy that capital, they're able to seize those other opportunities through the anticipated distressed assets. And we've had a number of clients that we've worked with in the last 2 weeks saying, Jim, I need to move this because I have this property I've already earmarked, or I've identified that I want to purchase, and I want to take advantage of that. So they've conceded some money on the front end for their down leg to be able to yield a tremendous opportunity on redeployment of the capital into the next property. And then ultimately, you have to ask yourself, where are you in your life? I mean, when we're all younger, we have a much higher level of risk tolerance, and when owners and landlords transition into different chapters in their life, their risk tolerance reduces and they go more into a preservation of wealth mode. So, you must withstand your tolerance, your patience, your time, your energy as well. All this needs to be examined and really measured. Because we are in anticipation of a valley and then a slow build up let's look at 2008. You know, many landlords, multi-tenant landlords, they had to slash rents just to keep their tenants, just to make sure they didn't have a mass exitive and a huge vacancy. And many of those rents never made it back up to the same level that they were at in 2006, 2007 after 12 years. So do you have the stomach? Do you have the timeline? Do you have that patience and energy to go through that whole unknown process of you know, worry and concern and unknown? Or are you in preservation of wealth mode to capture now as much equity as possible, maintain that equity, and then exit and then redeploy into maybe a different product type or a different asset class? And so you really need to, you know, examine your risk tolerance. Are you conservative, or are you in your adventurous and opportunistic mode? Also, another consideration is how leveraged are you? Obviously, that's a huge component that's in the equation. And, you know, what level of capital reserves and liquidity do you possess at this time? And we have, again, encourage you to allow us to examine your situation in real time and assist in our strategic recommendations from a true unbiased perspective. And, you know, really, what does this mean for investors? Well, what you want to do is, if you do have, we do have properties under contract. We're really examining the equity position of the buyer. We're examining the debt and we're getting updated quotes in real time from their potential lender. And then we really need to re-understand and re-examine why that particular buyer is buying. And then if you're considering of executing a disposition, you certainly can't catch a fish if you don't have a lure in the water and you're not fishing. So, you know, a lot of buyers, they think about purchasing before they're ready to act. And so a lot of buyers are home. They don't have all their resources. They have more time, and we're getting a flood of inquiries and interest in a lot of our deals that we currently have on the market for those specific reasons. And then, of course, 1031 buyers need to buy. They have a window that they must perform within. And we put a few deals under contract in the last couple of days just from 1031 buyers. You know, and then, like James Menefine was mentioning, many deals what we're seeing are being proactively extended by brokers and lenders, because otherwise, if you don't offer that pause to buyers, then the deal collapses. And so extensions are definitely natural in this climate. And then, you know, again, we are beginning that this is the global economic catalyst that we all worried about, that was really tied to a potential economic downturn or a major market correction. We know that cap rates will increase, vacancies will increase, over-leveraged assets will be lost, the cyclical consumer consumption will decrease, you know, with all the unemployment and the unknowns, and the inability for them to spend is obviously, even when your tenants are resurrected and operating on all cylinders, it's still going to affect their ability to maintain profitability within their individual business, as well as pay their rent and be profitable and perpetuate their tenancy. And we also have heard from certain buyers that they say, hey, Menefine retail team, we're looking for steals. We're not looking for deals. Now, while that's only a whisper at this time, we know that that's going to transition to a voice, and eventually it's going to be have a major prevalence in our market. So, you know, what's interesting too is prior to this pandemic, our consistent intelligence expected a market correction. And for the last 18 months, many of our most astute and sophisticated investors, they've been selling, they've been maximizing the timing of the market, maximizing their equity position. But then, even though they had a very low basis, they didn't 1031 exchange. They paid the tax consequences because they wanted to maintain liquidity on the sidelines, so that when an event or a recession or the correction occurred, they would be in liquid form and they could really capitalize on those opportunities that exist. Also, we encourage certain landlords in certain situations to examine repurpose opportunities for potential mixed use or conversions of your existing property. And so there's numerous reasons why to sell and buy. I just went over several reasons why it might be advantageous for sellers to consider a disposition. One general fact is, you know, when the herd moves in one direction, we see our most strategic and sophisticated and successful buyers moving in the opposite direction. And James Garner will now go over in detail the acquisition considerations for you as an investor.
Yeah, thanks, Jim. You're entirely correct. I mean, you talked about it on the disposition side, but on the acquisition side, we're seeing the same thing. So while a number of buyers have pulled back, they've hit pause, they're deciding, what should I do? Let me take a second to see how things play out and purchase. Some of our most savvy investors are the ones that are taking the opposite approach, and they're really looking to lock in super low debt, and take advantage of that, get it fixed for 10 years, and be able to capitalize on some opportunities. We're also seeing a different buyer pool kind of flood into the market. I'm getting calls from clients who are exiting their stock position, and they're looking to move that capital into hard assets. And now some of these investors may be capitalizing on a gain, although it wasn't as much of a gain as it was, a couple days ago. They may have purchased a while back when the shares were pretty low, and so they're capitalizing on a gain. Others may be taking losses, but both sides of that buyer pool are asking me for long-term secured net lease deals to put their money in some hard assets and hedge some of the risk, especially because it can be far more attractive than bonds. It's a unique environment, and we saw that bonds actually became less attractive when normally in this environment it goes the other way. And so a lot of people are looking for real estate as a way to create that bond-like income from the passive income of a long-term secured net lease deal, but also be able to capitalize on appreciation and equity moving on down the line. And so it's definitely an opportunistic time period to purchase. I would say you just need to be more critical on the properties that you're looking at, the properties that you're considering to buy. And so, a lot of our clients built their wealth in 2009, 2013 from distressed assets. And while the banks shut down back in that scenario, and right now they're still doing some loans, and so it's slightly a different environment, and also why we're a little optimistic that things will bounce back sooner than they did in the Great Recession. Now is definitely a time to investigate some of those opportunities and really try to find the diamonds in the rough, find the opportunities that are going to be good long-term value-add opportunities or net lease deals where you can park some money, you can still collect rent, and hedge your risk against the volatility of the market. And like Jim mentioned on the disposition side, you may have some limited competition on the acquisition side as well. While some of these buyers have pulled back, there may be fewer buyers to build that market. And while we're capitalizing on building markets from these new buyer pools, you may have an opportunity to get some deals where there's less eyeballs on deals just in general, and be able to have a little more leverage in purchasing a property to really find a solid deal. And then, maybe not necessarily today because it's still a little early for us to see the full economic impact on some of these assets, but there may be some motivated sellers in the next 6 to 8 months who maybe couldn't strike a deal with their tenant, or their tenant had to go out of business, or maybe they need to sell for personal reasons in an environment where per a long-term business plan, they should be holding on a little longer. And so keeping your pulse on what's out there, what's trading, where the opportunities are is a great way to find new deals. I would say if you're investigating a deal, obviously we're happy to take a look at it for you and help analyze it for you. But some of the few things and key things I would look at to make sure that it's viable in today's market are the tenant and concept viability. So where has the concept been trending, and where does it look to be going in the future, especially in terms of consumer demands and preferences, the guarantee on the lease. And obviously corporate guarantees are secured cash flow streams, but there are some very strong operators, franchisees that operate at a very high level that will make it through this and actually come out on the other side stronger and find opportunities to acquire and expand their footprint. And so understanding both the tenant and the guarantee that they're willing to put on some of these opportunities will help you identify what a safe deal would be to park your money in the short term, and then be able to structure a long-term business plan on that. And that ties into the lease term remaining. So if it's a shorter term lease, understanding where the rents are, what the tenant is looking to accomplish, and where you might be able to add value by extending that lease and creating a long-term passive deal, or buying a long-term secured deal that you can set and forget and not have to worry about the volatility of some alternative investment vehicles. And then base rent increases. It's important to investigate that and make sure that it's in line with the long-term sustainability of that tenant, the concept, the sales, all of those items. And like Medifine mentioned before, the spreads right now are enormous. And so that's why we say that a lot of our most savvy investors are looking for those deals to buy, because the debt is extremely cheap, especially compared to the historical averages. And if you can secure cheap debt and get a slightly higher cap rate than we've seen in the past 6 months, your spread is so big that your cash on cash return is going to be extremely attractive on some of these deals purchased in the next 6 to 12 months. Medifine, if you want to move to the next slide. So Jim's going to kind of go into detail on some of that analysis that we do. And like I said, we're obviously here as a resource for you through this time. There's going to be a lot of varying needs inside and outside of a transaction. And, you know, there's a lot of ways we can help you. So Jim, take it away.
Thank you, James. So, you know, about our team and our real focus, we are not transactional based. I mean, we do a lot of deals, but we really work with our clients long term, and we have multiple goals. And when they're in their hold period, we help them maximize their NOI, reduce their expenses, and ultimately increase their equity position of their property. And in multi-tenant retail, that often takes many years. And when it meets the timing and their equity position is in the right place, that's when we're able to discuss a sale and bring their property to the market and implement our proven process in that capacity. But we, again, I'm going to repeat it. We want to build clients for life. We're here to help. We have a saying that's, you know, our clients' goals are our goals, and we embody that spirit. And I think that we demonstrate that. And that's why we have repeat clients and clients that entrust us with their multi-million-dollar assets and often their portfolios, and repeat clients. You know, one of the things that we would recommend is take us up and take advantage of our proprietary analyses and models that we've created and that we've customized, and really execute a comprehensive deep dive on your property, particularly in this environment. Like James Garner mentioned, a tenant and land analysis, a void analysis, a concept analysis, a leakage report, a market rent analysis, but most importantly, a SWOT analysis. SWOT is an acronym for strengths, weaknesses, opportunities, and threats. And all those other ancillary models go into building a SWOT analysis. And we can put your property under a microscope and dissect it, and then we'll lay out the facts for you. And the information doesn't lie. You know, it's important that we provide the information that our clients need to hear, not what they want to hear. Often we have to communicate very unpopular information, but we know it's in our client's best interest. And our goal is really to allow you to make the most educated and informed decisions. And we also pride ourselves on our availability and our response time. So we're available in real time as this situation changes hour to hour and day by day. And now what we're going to do, well, first I want to thank everyone on behalf of James and James. And now we'll transition into a question and answer session.
Absolutely. Thank you, Jim. So we did have a few questions that folks submitted. If you have any questions, as I mentioned, feel free to type them in the bottom of the screen. We'll be sure to address them and provide any insight that we can. One of the questions that came in was being asked regarding the CMBS financing. And they were wondering what the impact has been, or what their interest level has been as it relates to the post-coronavirus crisis. I know I've had some recent experience with that, so I'll answer that question. CMBS lenders as a whole have pulled out of the market. Even several deals that they're close to closing, they've withdrawn their commitment letters on. A lot of that is related to the stock market. They're a lot more susceptible to the ebbs and flows that we see, or the ups and downs that we see in the market. And so it forced them to pull back and reassess. Now, the good news is they weren't super active to begin with. They were a relatively small portion of our overall financing environment. We still see banks lending on well over 50% of our deals. I know the market is trending very similar, about 50 to 75% on average is what banks end up financing. And then life companies are the second lender. They're still financing as well. They do have some non-recourse or limited recourse options, which are worth considering if you were thinking about going the CMBS route. Life companies will typically offer much better interest rates than CMBS lenders anyways. And so for the longest time, that has been a more attractive option for folks. The one negative is that life insurance companies are extremely expensive to originate, and so in most cases, that's the reason why a borrower will tend to go with a local or regional bank. Their rates are on par or a little bit better than life companies. They're cheaper to originate. The unfortunate part is they do require some level of recourse in most cases. One additional question that we received was related to why would anyone buy in today's climate? So obviously a lot of uncertainty that we addressed in this call. There's a lot of things that are going on that would point to I'm going to sit and wait and not do anything. Jim or Garner, what have you guys heard as it relates to why people are buying today? Because I think that's a good question.
Yeah, definitely. I touched on some of this, but it's really the philosophy that when everyone goes left, go right. That's what a lot of people did back in 2009 in the Great Recession. While some people could not have the capacity to do that and didn't have the cash on hand, I think there's going to be a lot of people poised to do that, especially considering that lenders are still doing deals. And so although it comes down to the specific deal in question, if you have the cash, you can take down some of the value add opportunities that the lenders aren't going to be willing to look at and be able to capitalize on improving that over time as the tenant mix changes and as tenants back out. On the net lease side, being able to take advantage of these long-term deals and being able to lock in cheap debt allow you to even take a smaller cap rate than you might normally look at because your cash on cash return is going to be very good because of the spread.
And I'll chime in and add to that, James. Right now, we're in a high level of vulnerability, and some landlords, the unknown is worse than the known. And so, once we are on the other side of A, there's a vaccine, B, the curve, and there's a certain level of normalcy that begins to take shape, the level of unknown and concern and fear will slowly subside. And so, there are vulnerable owners and landlords in the market that are also motivated by, hey, I'm going to come into this purchase. I'm going to offer you 85% of list price, but I'm going to guarantee to close and I'm going to buy it as is, barring inspections. But I'm not going to penalize you and re-underwrite this 5 or 6 times as you have this potential tenant fallout. And highly vulnerable shopping centers and landlords that have already decided to exit the market and already are ready to redeploy, that's very attractive for them. So it does create opportunities that we can work strategically with buyers to orchestrate. I'd also say that, like James Garner mentioned, limited competition, huge spread, and opportunistic times. So there are windows for buyers to perform within that they can. Another one final point is that currently you have bleeding product types, and those are most susceptible and vulnerable. But if you have a forward-thinking buyer and an acquisition, and you know that this is just a blip in the radar, I mean, look at shopping centers. We all know that the new anchors are experiential tenants, movie theaters, fitness tenants, restaurants. Those are the ones mostly impacted at this moment. So there's also a high level of susceptibility and vulnerability for landlords within those particular product types that a purchaser can capitalize on because they're a forward thinker and they're saying, this is a legacy property. I'm going to have it in my family for 20 or 30 years into the future, and obviously this time will pass. So there are certain opportunities and windows, and we certainly would welcome the opportunity to help you and gauge and examine any properties that you might be considering for acquisition.
Great. Well, I want to just follow up and thank everyone for the time. Hopefully this was valuable. If we receive good feedback from everyone, we'll continue to do more of these in the future. And if there's anything we can ever do for you, even if you're not considering selling, we're always here and happy to go to work with the idea that down the road when it is time to sell, you'll consider giving us a call and hopefully having the opportunity to work together. So hope everyone stays safe, has a great weekend, and we'll hopefully talk to everyone soon.